and welcome our webcast comparing the candidates' tax plan to the legislative agenda. I'm Justin Allard. I'm a tax partner with our firm. I'll serve as moderator today. Our secretary is Sam Hemmeter. Sam is a principal with our firm. Sam earned his bachelor's degree in accountancy from Wright State University and a master's in taxation from Capital University. He has 17 years of experience, including 13 years with one of the Big Four firms. Sam's experience includes tax planning and consultation with closely held and SEC clients, manufacturing, energy, financial services, real estate, and distribution industries. He's with a variety of clients assisting with business succession, merger acquisitions, international structuring, state and local taxation, and accounting method opportunities. Items before we get started today. First of all, those of you out there that are interested in CPE, you should have received a CPE credit information sheet this morning in advance of the webcast. I will be asking a few questions throughout the presentations that are listed on the second page of that document. Verification questions 1, 2, and 3. Again, if you're receiving CPE for this webcast, please listen for questions, fill out this form, and send it to us. Also sent out this morning a participant evaluation form. We'd certainly appreciate any candid feedback you have on the presentation. And again, if you can fill that information out and get it back to us, I think the instructions are on the participant evaluation form. We'll have this open questions. Look in the bottom right-hand corner of your screen. We certainly encourage you to ask as many questions as you have. Frankly, we want to try to progress through the slides as quickly as we can. Immediate attention this topic is received lately. We suspect we'll receive quite a few questions and certainly welcome those. Last but not least, we do have a webcast scheduled on Tuesday, November 13th, 1 week after the election, and that webcast will really be to drill down into the specific proposed by the candidate that wins the presidential election. We'll be covering some of the similar material as we're going to cover today. We'll probably drill into a little bit more detail on the election. With that, I will turn it over to our presenter, Sam Hemmeter.
Thanks, Justin, and I want to say welcome and thank you to everybody who's in attendance. Let's flip to the first slide, which before I get going, I do want to reiterate what Justin said and encourage everybody to chime in with questions because, as most of you know, a presentation can get pretty long and dry without sections. So I encourage you to submit questions electronically and try to cover those as they come in. Let's get started on the agenda. To start with, I want a legislative landscape. I've got 2 slides that cover that topic and kind of lay out where we currently are and what the potential items, if you will, given the current election. And then I have a lot of slides, I think about 10 to 12 of them, that cover a new tax that was enacted as part of the Patient Protection and Affordable Care Act, which was essentially ratified by the Supreme Court here in the last 2 months or so. That kicks in on January 1, 2013. So I want to cover that. It's new and it's broadly applicable, so that will be covered in depth. And I want to say 6 to 8 slides. We're going to cover specifics from income tax planning perspective under President Obama, or in the alternative scenario if Governor Romney is elected. And then a few items on business tax planning, and that should cover the agenda. Before we move on to the next slide, I do want to kind of emphasize that the focus of our presentation today is on folks who are high-income taxpayers generally with an AGI in the $250,000 range. The reason for that is because there are a lot of changes for low-income taxpayers, but they're relatively minor, and there's not much planning that can be done around those items. Most of those taxpayers have very little, if any, control of those changes to the legislative landscape. So with that, move on to the third slide. to legislative landscape. And everyone is aware the Bush tax cuts that were enacted, I think, back in 2003, or at least became effective in 2003, to sunset on January 1st, 2013. And what that means is that for long-term capital gains, the current top rate for high-income individuals is 15%. That's set to go to 20% under the sunset scenario. And the more dramatic increase in tax rates is on dividends. Currently, dividends are subject to a 15% rate. If nothing is done and the rates are allowed to sunset, those rates will go to 39.6% for those folks in the top, income brackets, and even above that amount to a 43.4% when you throw in the surtax on that was enacted as part of what's referred to commonly as Obamacare. And lay of the land currently, in addition to those changes to the capital gains and dividends rate, there is a slight uptick in just ordinary income rates for those in the higher brackets from a 33% rate to a 36% rate, and then from a 35 to a 39.6% rate for those that are making well in excess of $250,000. Again, that's the current state if the current rate regime is allowed to sunset. Here in 6-8 weeks, both the House and Senate passed bills that are trying to address the sunset, and those bills that by and large would be leveraged in a lame session of Congress after the election here on November 6th. So, if history any kind of guide, back in 2010, midterm elections, what was done was a House bill was essentially through the lame duck Congress after that midterm election. I think the scenario will work out the same, but as is often is the case here, they will likely reload, if you will, one of these bills, try to push that through if need be. So let's talk about those bills a little bit. Under the House bill, the House, as most people are aware, is controlled by the Republican Party. They control 55% of the House of Representatives, and that will largely retain, and I think it does retain, all of the current Bush tax rates. So if, in fact, the bill were enacted, there wouldn't be much tax planning that would be desired or required. We'll touch on one wrinkle to that later, but by and large, that's the way to think of that. The Senate bill, the Senate is currently controlled by Democrats. I think they control 51%. If you throw in a few independents, they control up to 53-54% of the Senate. In that bill, the capital gains rate for long-term capital gains would increase to 20%, as for qualified dividends. So there's a little bit of a split between a pure sunset scenario on dividends in the Senate bill. If the Senate bill were enacted, the dividend rate would be capped at 20, whereas if it's just the Bush cut just sunset, they will go to 39.6% plus for those in the top rate bracket. Again, those are folks making over $250,000 in adjusted gross income.
Sam, in the recent presidential debate, I know Mitt Romney has mentioned the notion of lowering marginal rates in the neighborhood of 20%. Which one of these bills his proposal might be reflected in?
The answer to that is neither one of these. He has mentioned a few things that were frankly news in at least the most recent debate for middle-income taxpayers. Really, the House bill is designed to carry on with the current tax rates. There's no real true lowering of tax rates. So the short answer is that some of Governor Romney's proposals essentially are not covered in the House bill or the Senate bill, for that matter. So unless there's any questions on this slide, we'll move on to the next one, which is slide 4. And this is an area that I do want to spend quite a bit of time on because based on the current legislative landscape, it's very difficult for these new taxes to be repealed. Our taxes that were essentially ratified when the Supreme Court upheld Obamacare here in the last couple of months, and so, Governor Romney has stated that he will, on day one of his administration, try to repeal Obamacare. The reason I think that's somewhat unlikely is that we currently have a Senate that's controlled by Democrats, so a total repeal is likely unless there's a wholesale change in the makeup of Congress. Again, it's somewhat unlikely. So I'm going to emphasize this tax was ratified and enacted as part of Obamacare quite a bit here over the next few slides because it's new, it's a new tax. Again, it does apply to just folks over the $250,000 in AGI. And the tax, there's two components to it. There's a Medicare tax of 0.9% on wages. That is a withholding requirement that will kick in on January 1st for those making in excess of $250,000. And then a surtax, with a 3% tax on net investment income for folks in that $250,000 income category. And that's the one I'm going to focus on the most, again, because it's new, and it will be something that will be filed as part of their individual income tax return, and they can plan around it. By and large, the 0.9% withholding, very difficult to plan around a withholding requirement. So let's move on to slide number 5. Yeah, our intention is to just cover this Medicare tax on net investment income in a little bit of detail. The way the tax works, again, it's in for married filing joint taxpayers with GIs of $250,000. It's a 28% tax on the lesser of net investment income or adjusted gross income. My adjusted gross income is basically their adjusted gross income without any exclusion for foreign earned income. Beyond the scope of this and not a very common exclusion. So just think of it as your AGI for this purposes. And so if you exceed that threshold and you have net investment income, you're likely to pay some tax, additional tax. Let's move on to 6. Net investment income includes taxable interest, capital gains, annuities, and rents. The key word there is taxable. So if it's otherwise excludable, it would not be subject to or not characterized as net investment income.
Clients asked me about this tax and questioned whether it was perhaps applicable to the sales of homes. You know that?
Generally speaking, the sale of a principal residence is not subject to U.S. taxation because an exclusion that applies if you meet certain pretty broad tests. And that exclusion amount, I think, for married filing joints, $500,000. Current market, it would be rare to see somebody sell their house with that kind of gain in it, given the press value of home. That gain is excluded from taxable income and thereby excluded from net investment income. So next slide or two, we're going to cover some examples of how this new net investment income works, the Medicare surtax. In this first example, we have a couple that are what is high-income couple. They have $200,000 of salary, $150,000 of net investment income that would otherwise be taxable. Tax works is it would apply to the lesser of $100,000, which is their net investment income, or $350,000 less the $250,000 threshold amount for $100,000. So the surtax applies to the lesser of $150,000, which is investment income, or $100,000. So it applies to $100,000. They will owe an additional $3,800 of tax due to tax. The next slide covers some items that are excludable from the tax. Tax-free, if you will, municipal bond interest is not subject to it. Qualified plan distributions are not subject to that. Social Security earnings are not subject to the tax. Life insurance proceeds and the increase in the cash surrender value of an insurance policy are not subject to that tax.
I'd like to jump in now and ask our first verification question for CPE purposes. And I'm not going to phrase it as a question. The answer should be 1, 2, 3.
Okay, that will skip on to slide 9. This slide includes an example of life insurance which is exempt from the surtax. And in this example, we have an individual named Tim who pays a $250,000 premium for a $2 million second to die policy. At 10 years, the value of the policy is $450,000. Tim has $50,000 from the policy out of that inside buildup of the policy, if you will. And that income is not subject to the surtax because his basis, if you will, in that policy is $250,000. Until his cumulative withdrawals exceed that $50,000 amount, he would not pay any of this surtax. The next slide is regarding tax-exempt interest and how that's excludable. We have a single individual who has $180,000 of salary and $5,000 of taxable interest and $1,000 of dividend income. He inherits $1 million. That inheritance is not subject to income tax under the Internal Revenue Code. But his question that's rolling through his mind is, how should I invest $1 million? And the next slide, slide 11, covers an example where you analyze the after-tax return on an investment in either taxable corporate bonds or exempt municipal bonds. In this example, which frankly I did check interest rates, and this example was not entirely grounded in reality, but for purpose of our presentation, it's wording that if you have exempt bonds that were earning 4.5%, tax, obviously the return's 4.5% by virtue of the fact that they're tax exempt. Bonds yielding 7% tax yield on those taxable corporate bonds is only 4.2% after you multiply it by his 36% rate, this new 3.8% surtax. Okay, we're going to talk a little bit about how this tax applies to trusts and estates. Many of our clients have used trust from an estate tax planning perspective. Here's one wrinkle to how they're going to be taxed from an income tax perspective. The tax does apply to the net investment income of a trust, and because the brackets for trusts are so much lower, it's going to be not tax beneficial, I guess I should say, to retain the earnings inside a trust. So this example covers that. The current surtax for trust equals the lesser net investment income or the trust's AGI in excess of a threshold of around $12,000. So that's quite a bit lower, as you can tell, that threshold amount than individuals. So an individual who has less than $250,000 of AGI owns the trust, or I guess owns isn't the right word, but is the beneficiary of the trust. They should do everything in their power to make a distribution out of that trust to themselves by avoiding this 3.8% tax, because trusts get a distribution deduction, and they pay the tax at the trust level. Okay, the next slide, slide 13, we just emphasized the point I just made for a trust with income of $100,000 and net investment income has $20,000 of deduction. Assume beneficiaries are in a 20% income tax bracket. They save income and surcharge taxes, this new tax, of $21,000 if they make a distribution to themselves of $80,000. So you hear that what ours is from an income tax perspective, this surtax merely amplifies from a planning perspective. The next slide, 14, are just a few other minor planning items relative to this. surtax, converting a traditional IRA to a Roth IRA. Last time I checked, high-income folks can still do that, so people with AGIs above $250 can convert a traditional IRA to a Roth. One thing they should be considering, or their tax accountant should be considering, is that they can choose to convert a portion of their traditional IRA to a Roth as opposed to the balance, thereby managing their TGI and reducing this tax. Net worth clients who own charitable remainder trusts or who have funded them can essentially manage earnings from that trust as well, especially in a net income makeup charitable remainder trust setting, a NIM credit. So that's something else to keep in mind if you have clients or if you have a charitable remainder trust, they use it as a vehicle to manage earnings and minimize that tax. Slide 18, the next slide, is planning around this new surtax. And in this one, the concept I want to address is that when a company or an individual sells as exchange for a note, which are deferred to future periods, generally the tax law requires that they report the gain ratably over, not ratably, but in proportion to the payments that are received in future periods. So the tax hit, if you will, is deferred to future years. Well, in this environment with capital gains rates and this surtax, a tax sold a business this year who sold it for a note may elect out of the mandatory installment method with respect to that sale and analyze the tax at today's preferential long-term capital gain rate of 15%, as opposed to what might be at least a 23.8% capital gain in the future. The mechanics of making that election are fairly simple. If you have a question on that, I'd be more than happy to help.
Just add in terms of the installment sale planning, I think the advantage that clients would have there is that the election can actually be made when you file your tax return. So
that's right. If
Congress is able to get their act together and actually decide what legislation is going to look like and what the law is going to look like on January 1st, 2013, we'd be able to do this with the advantage of hindsight.
That's right. I actually have a client that sold a business this year that terms of the source such that they're getting some payments actually late August of 2013, and we discussed the idea of extending the return and waiting to see what those payments are and what tax rates are going to be, and electing in that 2012 return to elect out of the installment method. Good point. The next two slides, I believe, deal with more sophisticated estate and trust planning. It touches topics that I think I've already touched or discussed. One is deduction from an income tax purposes to the extent they distribute out taxable income to the beneficiaries. The rule that allows those trusts to treat a distribution 65 days of year-end as made every year, such that who prepares the trust taxable income calculations has some time year-end to make the calculation and to determine how much should be distributed to the trust and treat it as a prior year distribution, and thereby reduce or eliminate this surtax. Next slide covers the income taxation of estates. Estates are like any other taxpayer. Once assets are into an estate, the estate is subject to income tax, generally speaking. About estates is that they can choose any year-end that they want to choose, and because surtax applies to years beginning after January 1st, on or after January 1st, if passes away and is going to have a tax or estate with producing assets in it, consider adopting a November 30th, 2013 year-end by avoiding this on the income of that trust, or excuse me, estate. With that, let's go to slide 18. We're into kind of more generalized income tax planning, and in this case, if President Obama is reelected under his plan, things that taxpayers that are in the $150,000 income or AGI level or above should consider. The first bullet point that I bring is that they accelerate some itemized deductions into 2012 because under President Obama's plans, there's a likelihood that they will what's called P's limitation on deductions will be kicked back in, if you will, to phase out certain itemized deductions. If you're a person who has over $250,000 in AGI, you might want to consider prepaying some state and local taxes, or making some charitable donations here at the end of the year to minimize and take advantage of those full deductions when, in fact, they'll be limited potentially in the future.
This phase-out concept or limitation on itemized deductions, isn't it true that Governor Romney has also at least spoken about some sort of limitation on itemized deductions or cap?
That's correct. Governor Romney has brought up in both debates, part of the philosophy is to lower rates on more of a broad basis, but then to minimize certain tax planning, what's often referred to as loopholes, which aren't necessarily loopholes, and to put a cap on, if you will, itemized deductions. His theory is a little bit different than the phase-out that we're all kind of accustomed to, that were, I think, enacted along by Herbert Walker Bush, but it would still come in and limit the value, the tax value of those itemized deductions. So let's move. One point I want to touch on here that high-income individuals should keep in mind from this plan perspective is that sometimes itemized deductions does not really lower your tax bill if you're an AMT taxpayer, especially if you're a chronic AMT taxpayer, especially state and local taxes, because those are an adjustment for AMT. Prepaying those in 2012 will not reduce your tax bill at all if you're an AMT taxpayer. So that's something to keep in the back of your mind. I'd continue some of the planning relative to Obama's plans, and he does plan to replace AMT with the Buffett rule, and the Buffett rule kind of acts like AMT for folks who make $1 million a year or more in AGI. It would require those taxpayers to pay a minimum amount of 30% on their income. Again, another consider accelerating income into 2012 if you're in that 1 million up AGI status. So that's something to consider as well.
I can't get too deep into politics here, but I know there's been a lot of press around this Buffett rule, and I believe the premise for that is that we have a wealthy taxpayer that has a higher effective tax rate than the secretary. Curious your perspective on whether you see some of our high-income taxpayers that are lower effective rate than more modest income taxpayers.
Yeah, that's a great question. The notion that taxpayers pay a effective rate than middle-income taxpayers is by and large not. I mean, if you divide, the middle-income person divides their tax that they owe at the end of the year by total income, generally the effective rate is well less than 15%, which is the long-term capital gain rate, and is the minimum somebody that rule is intended to attack would pay. Good question. For high net worth individuals or married couples, especially in the current environment, relates to the estate and gift tax. Current exemption for gifts, as almost everybody knows, a gift to someone is generally to a transfer tax under our revenue code, referred to as the gift tax. And when you pass away, to the extent your cumulative gifts and your estate exceed this exemption amount, you tax on that. It's referred to the estate tax on that. So folks who have a fair net worth should consider taking advantage of the current exemption amount of $5 million. That is to revert to a $1 million exemption amount on January 1, 2013. That doesn't, it seems like numbers on paper to a lot of people, but a $4 million difference taxed at what may come or revert to a 5% rate is in excess of $2.6 million of tax savings on an individual. So for business owners, high net worth who have sold a business in the past, they should strongly consider gifting assets to take advantage of this exemption amount now and lock it in to avoid that additional $2.5 million of tax. Individual, for a couple, obviously the tax savings would be, because the exemption is $5 million per individual, tax savings would be well in excess of $5 million.
To step in at this point and provide the answer to the second CPE verification question. The answer to the question is 456. Again, that's for verification question number 2.
I'm going to slide 21, which includes further kind of tax planning tips for high net worth individuals. Again, the exemption amount we talked about. If you've already gifted enough to utilize your entire exemption amount, now is not a bad time to make a gift because the gift tax rate is currently 35%, and that is set to reverse to 55% on January 1. So on a $1 million gift, if you've already used your exemption amount, the savings would be $400,000 at the federal level. That's the spread on the rates of 20% times a $2 million gift. It's a fairly powerful tax savings opportunity.
Sam, clients that look at gifting assets, particularly if it's a business interest, the concern they seem to have is, how do I gift this asset and still retain control? Is that the ability to transfer net worth estate if it's a business interest and still maintain control of those assets?
Excellent question, and it's something I've recently worked through with a client that was some weary of relinquishing control of assets because of their age. They weren't at an age where they felt comfortable turning that control over to their intended beneficiaries, their children. Children were a bit too young to responsibly manage those assets. So they have some trust, and under the way the gift tax works and based on certain tax law and case law that exists, for tax purposes, that really does not change their ability to manage the asset. And to go a discussion of the nuances of that, probably beyond this presentation, but there's something referred to as an ascertainable standard. If that's the only, I guess, interest or right they have over those assets, they can affect a gift tax purposes where they truly retain the control, if you will, of the asset. So it's a great question. At the bottom of the slide, I mentioned a few of those trusts. They're split interest trusts, whereby the income interest is either retained or gifted away, and then the interest or reversionary interest goes to another party or is retained. And then I mentioned a few of them, a few examples. Charitable lead trusts, that's where the individual income interest in the trust, or excuse me, I had that backwards. The individual retains an income interest. The trust assets that remain after that is funded go to the charity. Retained annuity trust, again, the individual retains an annuity. If you're in the bracket and have these concerns, talk to an attorney. And certainly give me a call or Justin a call about your questions on those. Switch gears a little bit and chat about if Governor Romney were elected. By and large, he has indicated that he would extend the share tax rates so all planning applies if he's elected. In other words, traditional taxpayers want to defer income for tax purposes and accelerate deductions. If Governor Romney is elected on November 6th, that's something that I think we all need to adopt. The one on that is tax that I mentioned before that was enacted and ratified by the Supreme Court of 3% on net investment income. That tax is going to be very difficult Romney to get repealed given the Senate controlled by the Democrat Party. I think that if you access $250,000 of AGI or more, you should strongly consider gains, especially capital gains, even now. But if Obama is reelected, if he's in Romney's elected, then the planning paradigm shifts a little bit, but you have to keep this surtax in the back of your mind because although 3% doesn't seem like much on a big number, it's a big number. Okay, then slide 23. Just tax planning if Romney is elected. Again, if you're considering the sale of your business, to me, I think you want to get the deal done before the end of the year, regardless of who's elected, because, you know, even Romney's telling us today, may very well go up for upper income individuals, or at the very least, their itemized deductions will get phased out. So that type of planning, I think high income individuals need to keep in the back of their mind. And in addition, the other, I guess, wrinkle that Romney has thrown out there as part of his longer term plans is to complete rid of the tax regime. If you are a high net worth individual and you've already done planning to take advantage of the $5 exemption amount, and you made all of the gifts that you possibly can and avoid on them, you may want to consider making any further gifts until you find out who wins the election. Clearly you want to defer gifts after he enacts his plan to abolish the estate tax. Switch gears yet again and cover planning relative to businesses in this current legislative environment. And the biggest, I guess, change, or I guess set that may kick in relates to bonus depreciation. As many of our companies are aware, I'm sure there is special depreciation provisions enacted, I think under George W. Bush's administration in reaction to September 11, 2001, intended to incentivize investment by business, and it's referred to as depreciation or bonus depreciation. Allows a company that buys an asset for use in its trade or business that's a new asset, otherwise qualifying, to take 50% write-off of that in the year of acquisition. That is to expire January 1, 2013. Not certain exactly what's the bonus depreciation, especially if Obama were to win election. My guess is that really expire if he's elected. If not, if Romney wins, I think you may see bonus depreciation reenacted. Goal to bonus that we're going to get into here a little bit is, again, I mentioned AMT taxpayers. If you're a chronic AMT taxpayer from an income tax perspective, bonus depreciation this year probably all that attractive. In other words, you may want to elect out of this deduction. The reason for that is if you claim the bonus in 2012, it will merely deepen your AMT tax position. State and local deductions, which are an adjustment for AMT, are relative to your taxable income after claiming bonus depreciation. And time, over the life of the asset, you will actually incur more tax. So it's kind of a trap for the unwary. Bonus depreciation sounds great, but isn't always great. I really encourage clients and taxpayers out there who are in the upper to work with accountant to protect their true tax liability. Numbers, bonus versus no bonus. Kind of, I guess, beat bonus idea into the ground a little bit here. So let's move on to the IC disc. A lot of our clients who are exporters have an IC disc to take advantage of tax favorable treatment of IC discs. There may be some planning to accelerate a dividend for FEN discs if you have one, and take advantage of the current 15% qualified dividend rate in lieu of potentially a 20% dividend rate or higher in 2013. The next slide, slide 25, is more business tax planning. One that a lot of clients, taxpayers take is a Section 179 expensing deduction by assets, and that applies to both new and used assets, so it's a little bit different than bonus depreciation. Currently, there's a total 179 expensing available of $139,000, but that's phased out if additions exceed $560,000. That to under these sunsetting provisions to be reduced to a $25,000 expensing deduction and a phase out of $200,000. So obviously, for a business that's buying assets, Section 179 is something to take advantage of this year.
Also chime in with the observation after watching the last two presidential debates, somewhat of a conflict, particularly with President Obama, in terms of having wealthy taxpayers pay a percentage in tax and collecting more tax from that population, while at the same time kind of outspurring small business growth and giving growth for investment by small businesses. So a lot of our clients are pass-through entities, whether they're S corporations or partnerships, and those two concepts certainly seem to conflict with each other.
Well, yeah, I think, frankly, not too political again, but, he has said a few times on a few occasions that he has helped small business when, in fact, the credit in the small businesses for their health insurance payments is large, not available to a lot of taxpayers. It's one of those things that makes headlines but does not give any money in anybody's pocket. So your assessment is correct. So the next slide 26, is for businesses, and this is more for entities that are C Corps and S Corps. Just to touch on this, it's really planning around the current 15% rate. If you have a company that's a C corporation or an S corporation, you should be looking to take advantage of this current 15% rate. In the C Corp context, you're doing making a distribution that's characterized as a dividend. If you're an S Corp that has some history as a C corporation, you can have an election to treat distributions coming from that S Corp as coming from historical C Corp, such that you take advantage of the 15% rate. So that, I think, covers that slide. The next, well, not only are you taking advantage of the 15% rate, you are avoiding potential surtax of 3.8%. Lastly, from a business tax planning perspective, I just want to touch on the R&D credit, which is near and dear to everybody's heart who owns business. That credit has not been renewed. This is an incentive for businesses that's renewed for, generally speaking, an 18-month period. If it hasn't gotten done yet, as John mentioned earlier, we all wish Congress had their act together. This is one of those areas where they haven't come out with a renewal yet. So taxpayers in limbo from January 1 or for calendar year 2012, because it's not yet been renewed for 2012. I fully expect under either administration that they would renew this. It's kind of political football that they like to bring out and say they renewed this great incentive, but they do it every 18 months like clockwork so that they can say they did it. I want to move on and see if anybody has any questions, or Justin, if you had anything you want to comment about.
Our CPE verification question, again, the answer is 789. That's for CPE verification question number 3. I also see that we have a question from Monica, and I can say with a relative degree of confidence that neither Sam nor I know the answer to that question off the top, but we do contact info, and we'll look that up after the webcast and reach back out to you. Just for the audience's information, it does deal with Coverdale Education Savings Accounts. So we will look into that and circle back with you, Monica. If any additional questions, feel free to submit them now. That will conclude our presentation. I want to remind you that we do have another webcast scheduled for 1 week from the election date. That's on November 13th. If you haven't already received information on that, you will receive it shortly. We encourage you to tune into that discussion where we really drill down a little bit more into each candidate's policies and proposals from a tax perspective. Again, if you could complete your participant evaluation form, get that back to us, and extend you're seeking CPE. If you could send your CPE verification form, we'll make sure continuing professional education credit, and concludes our presentation for the day.
Thank you, everyone, for attending.
Thanks.